Welcome. My name is Anthea Hotzenberg. I head up operations here at CatalyzU, and I'll be your host for this evening. If this is your first time joining, thank you. Thank you so much for spending the next hour with us for a very interesting conversation. I'm very much looking forward to it. I am driving solo this evening, so I'll be looking at multiple screens, letting people in as they join the waiting room. But to all of you, really lovely to see you. While we wait for more people to join, we'd love to hear from those of you that's already on the call. I see a couple of people from our current fellowship. A big hi to all of you. You know how much we love connecting people within the network. So let us know in the chat where you are joining from. And then also please feel free to drop your LinkedIn profile link to allow the rest of us to also connect with you. Please drop a note, tell us who you are and where you're dialing in from, and then also please do share your LinkedIn link. We've got some really interesting people already. It's nice to see Geordie, one of our previous speakers, also in the room. Noi, lovely to see you as well. Really, really great crowd this evening. And to all of our fellows who's also joined, it's fantastic to see you all here this evening. While I let some more people into the room, for those of you who are joining for the first time, I'll be your host. My name is Anthea. I head up operations here, as I've mentioned earlier. And this is a webinar brought to you by CatalyzU. Who's CatalyzU, or what does CatalyzU do? CatalyzU vets, trains, and places Africa's leading non-technical talent into the global startup and venture ecosystem. Many of you will know us from the fellowships that we run. Our VC fellowship is by far the most popular, but we've also expanded into startup fellowships. We recently concluded a fellowship with Future Africa, which was the How to Startup in Africa Fellowship. And in October of this year, we'll also be launching our first Sales Success Fellowship, which will be a 5-week program running from October into the first part of November. Keep an eye out for that. I think it's going to be a really interesting fellowship overall. We've got some really cool lecturers lined up for that. In terms of technical details for this evening, so just a little bit of housekeeping. This is a Zoom call. I said every time we meet, but we are all used to it by now. If you happen to drop off at any point during the call, just use the same link to get right back on. When it comes to your video, obviously all of the speakers will have their videos on for the duration of the conversation. But for you, whether you're sitting in a car or you're sitting at home or in the office, doesn't really matter. Feel free to just keep it on or off. Unless you are asking a question, at that point, I will request that you please switch your video on, just so that we also have a bit of engagement. A note on questions: during the conversation, if you have a question, pop it into the chat. I'm going to keep an eye on that, and I'll make sure that I work that in throughout. If you drop off, as mentioned, just use the same link. And then finally, if you are having technical issues, I am flying solo, but I might be able to just multitask here. Pop me a DM, right? So I really appreciate Saeed's already let me know that about the sound. I figured that out now, or I'll figure it out for the next video. But if you have an issue, please just pop me a message and I'll try and resolve that. On that note, you can find us on all of the social media platforms that's on your screen at the moment. Our main channel is on LinkedIn. What that also means is that we will be sharing the video from this webinar. We will also be sharing the key takeaways in our newsletter, so make sure you keep an eye on that. And then we also have a very active WhatsApp group, which I always love reading about and seeing. We have two on the VC side, and then we also have one on the entrepreneurship side. So if you are interested in joining our community over there, I've just dropped a message into the chat. I'll do it momentarily, and then you can feel free to request access to that. Here we go. That's the link. So feel free to join that one. There's some really interesting people that's already part of that community. Before we jump into this, I have a very awesome announcement for those of you who are joining to find out a bit more about our fellowships. Next week, Monday, we are launching the 6th cohort of our Venture Capital Fellowship. The CatalyzU Venture Capital Fellowship, it's our flagship one. We're going into the 6th one since we started, and we are very excited to be partnering with 54 Collective, formerly Founders Factory Africa. They are sending a whole bunch of people from their company to join the conversation. So about 50% of our seats will be allocated to 54 Collective, which for people joining is a really great opportunity to also connect with people that's working at one of the most exciting VCs on the continent. And just to give you a little bit of a taste of what that's about before we jump into the conversation, let's listen to Alan Mwangi, who's the Entrepreneurship Development Manager at SAN Technologies, owned by ALX. And he's also a CatalyzU alum.
My name's Alan Mwangi, and I did the Advanced Venture Capital Fellowship at CatalyzU. I'm from Nairobi, Kenya. I work in fintech and media. My highlight at CatalyzU was access to very, very experienced tuition in terms of learning from VCs who've already been in the space, have made several investments, both at pre-seed, seed, Series A, and Series B level, and getting a lot of hands-on examples from them as to how these different investments worked, how they sourced them, how they did their due diligence on them, how they approached the founders, and also not just the fundraising process, but also how they dealt with founders afterwards. As an alumni, I have seen the structure that they go through. I have seen the level of instruction and the amount of time and effort that they put in to make sure the instruction is top level. So I do trust them to do that, not only from a venture capital side, but also on how to start and operate a startup, and a lot of the other sort of non-financial or non-technical skill sets that they hope to teach. I would recommend them to sign up right now. The best time to start was yesterday. There's a wave that's coming, I think, on this continent of people who are going to need jobs, not only the ones who currently don't have jobs, but the ones in future. And it's very much going to be reliant on the people who are building startups and operating startups to create these jobs through market creating innovations. So I'm hoping to see a lot more people sign up, start to engage with these programs, and also for those of us who are alumni, contribute and help to get as many people through these programs as we can.
On that note, I am going to invite our speakers to the stage. I am very excited this evening to be chatting to Sahil Afriya, Sahid Sohosemi, and Jill Kerr, who stepped in at the last minute to replace Egla, who is our speaker that you might have seen on the promotional materials. But really, really glad to have Jill step in this evening. And then while I invite the speakers on board, we're going to kick off with Jill. I'll spotlight you. Give us a brief introduction to you and then also to Misfit Ventures.
Hi, everyone. Thank you so much for having us here. Myself, I'm Jill Kerr. I've been in the venture capital landscape for about 5 years now, mostly in health tech and logistics. And myself and Egla and Tuba are launching Misfit Ventures, which is a $20 million POC fund investing in female-led SMEs in South Africa, providing them with working capital that is flexible and enables them to scale basic technology and infrastructure. Thanks.
Fantastic. Thanks, Jill. Lovely to have you. Saeed, over to you.
Hello. Thank you very much. My name is Saeed. I spent 3 years, started my career in private equity with Verod Capital, focused on West Africa, specifically Anglophone West Africa, which I guess is just Nigeria and Ghana, and focused on education, logistics, renewable energy. Then I pivoted to VC, so I was a venture capital investor for just slightly under 4 years with Echo VC, so focused on both on the continent and out of the continent, just minority-led businesses. And that was completely sector agnostic. Before I started Hadi Finance in 2022 with my co-founder Bidemi, We've been doing that for about 2 years now. Hadi Finance, we provide inventory financing to market men and women in the informal sector across Nigeria.
Thanks, Sahid. Lovely to have you. And then finally, Sahil, take us home.
Thank you so much, and good job, Anthea. You've been doing it really well. Thank you. So thanks for everyone who also shared the introduction before me. My name is Sahil. I am originally born and brought up in India, as you can guess from my accent. I moved to South Africa in 2018 when I came to my honeymoon, and basically I never went back. And since then, I've been throughout my life part of different startup across, like even in Indian continent, Indian as a country, continent. In South Africa also I did my MBA, and then after that I joined a VC fund, which was Avant Capital, and I spent my time there. Ended up leading their corporate with Sibon Stillwater to invest in different businesses. And as soon as I understood about the potential and opportunity on the continent about the startups, I resigned and to start ShipRaiser. And ShipRaiser is basically a last mile logistics aggregator. It's basically end-to-end logistics management platform, whether it's international delivery or local delivery. You can choose different courier companies based on your need. You can choose different warehouses based on your need. So it really allows you, whether it's B2C delivery or B2B delivery, it really allows you to have the best pricing to ship it. And we're currently live in Kenya and South Africa, and we have done a good job so far. Thank you.
Thanks, Sahil. I love that introduction, and thanks for also giving a bit of background on ShipRaiser, who raised some funding a couple of weeks ago. We will jump into that. But we have a jam-packed agenda today. I'm going to jump right into the questions. One of the things that's important as a caveat, the reason why we're having this conversation is obviously Africa the Big Deal released the data around funding in July of this year. And the positive news was that we had finally surpassed the 1 billion mark in funding for the continent, which is incredibly positive and a really good indicator. What we are not going to necessarily delve into is sort of the detail around the sectors that were being funded, specifically around how it compares to previous years. We really want to zoom out a little bit and look at this a bit more holistically across two main touch points. The first one is talking about alternative funding and the gap that exists specifically for SMMEs, so entrepreneurs in that space. We want to talk a bit about the lessons from raising. Both Sahid and Sahil will be able to touch on their own journeys around that. And in that sense, we also want to keep it quite real in terms of the experience so that we can help the community at large. If you are interested, Africa the Big Deal did a really insightful webinar, I think 2 weeks ago, where they went through the entire report. I'll make sure that I link to it a bit later, but I wanted to provide that context for this evening's conversation. But on that note, let's jump in. So everyone's been talking about what I was just talking about, which is, in July, we surpassed the 1 billion funding mark for African startups. I want to get a take from each of you right now on the call on what this means for the broader ecosystem and what you take away, if anything, from us or the continent surpassing that milestone. Let's start with you, Sahid.
Okay, thank you very much. On my end, I'll try to be as short and blunt as possible. Doesn't really mean much at all. For me personally, when you consider, and frankly speaking, for the ecosystem, I think looking at it in a vacuum versus looking at the trends tells us a little bit less. I think this in the month of July, 90% of the capital that came into the continent went to 3 deals. So on my end, I'm more interested about, I'm more curious about where investors, at what parts of the investor journey or in the founder journey investors are choosing to invest. What we're seeing is a lot more people are kind of moving away from Series A, closer to pre-seed. And what we're seeing in the market is investors are doing a lot more due diligence. They've become more risk averse. Even the pre-seed funds who used to write the first checks. So I'm going to speak specifically about Nigeria and West Africa because we know Africa is monolithic. We're competing for capital against businesses with customers in other markets who are wealthier, easier to acquire, easier to educate, and a lot of the time more adaptable. And we have macro conditions in this part of the world, it's worsening. So it stands to reason that capital is going elsewhere. It's just opportunity cost. That's the way I see it. Now, regarding what it means for the ecosystem, personally, I don't expect to see a lot of African VCs raising second and third funds. I think we can only live off the paystack sale for long, it's been 4 years. But that being said, I feel like the best funds will come to dominate the markets, and they also understand to a better extent the reality of building long-term sustainable businesses in Africa. And what we're also seeing, and this part is not based on data, but it's just of conversations with other founders. I'm seeing, please see that some of the founders of Series A plus companies who raised previously and whose companies are doing relatively well, they're sending the elevator back down, writing 20K, 30K checks to get pre-seed guys started. But bottom line, there's going to be less capital chasing more deals. So these days, if you want to get funding, you just have to be honestly better and just lucky. Checks would go to folks that VCs know and trust. And the latter bit, I understand because we've seen some of the bad behaviors on the continent, but it's also sad for folks with genuine products who do not have any network in the, who have no real network in the startup ecosystem. They're just passionate about building. So do I see an increase coming on the continent? Maybe. West Africa, with the worsening macros, I don't think so. So that's my view and my takeaway from this. We may be seeing investors pile into a smaller amount of deals, but when I look at it against the last few years, it doesn't really mean much, and it's not really something that I'm personally cheering on or cheering for.
There is a lot in there that I want to unpack. I definitely think that around your point around increased due diligence, 100%. I don't necessarily think that is a bad thing. I think there's definitely some stuff we can explore there. From a founder perspective, I really love that kind of juxtapositioning of if you have people that's just passionate about building, they are not necessarily going to be the best people to go out and raise. They want to focus on building. How do you balance that? Is there a need to balance that in the short term? But I want to also go to Joel and to Sahil. Same question. What are you taking from this? Us reaching this milestone in July, and if anything, what does this mean for us going forward? Let's start with you, Joel.
Thanks so much, Saeed. I loved the frankness with which you started this conversation. So I think I'll continue that. When I look at, we've only passed the 1 billion funding in first half 2024. That is 50% lower than it was the previous year. And what I think that means is there's a ton of dry powder sitting around in our market, because actually you've had some of the largest, VCs raise mega rounds to actually kind of do the next stage of funding. You had Norskin, P1, Partech as well, raise kind of like 500, nearly kind of large raises, but they're not being able to deploy. And interestingly, even though everyone said, okay, they've all raised a Series A fund, we're seeing a slowdown in Series A transactions, and we're seeing an increase in pre-seed or kind of earlier on transactions. So from my perspective, I think that what we're seeing is a lot of investors sitting on their hands, and they're not seeing the typical tech-only SaaS company startups coming out. And because of that, they're ending up saying, well, we're not meeting our mandate, so we're going to have to invest earlier to kind of build that up. But I think actually what it means is that you're missing the bulk of people that actually do require that funding. There are so many startups that are at the Series A stage that have taken 2 years to raise, even though they've reached all of their metrics, hit it all out the park, 2 to 3 times revenue growth, profitable in an industry that's defensive, and still it takes 2 years to raise. So for me, I think that we're seeing a shift now where people are realizing that maybe equity is not the solution for the continent, specifically for the bunch of SMEs that don't get funded. So yeah, fascinatingly, the venture debt actually is actually growing. It's not decreasing, and a lot of it's almost taking away from equity. And I think it's because we need to change our model to adapt to the actual businesses that are on the continent.
Jill, before I hand over to Sahil, maybe just a quick follow-up on that. So even those big VCs that have raised this year, adjusting their model is going to take time, right? So in the short term, what should they be doing to create value in the ecosystem where there are gaps, like in the SME space that you've mentioned?
So I honestly think it's about, Sahid very rightly pointed out that a lot of the times the entrepreneurs that are getting funded, it's luck. And it's because you're in the right ecosystem, you know the right people. And for me, honestly, it's about broadening this and engaging so that there's not the same pattern recognition again and again that just minimizes the base of people we can invest in. And I think, instead of, kind of, yes, everyone's doing a lot more due diligence. And I think that's a great thing, because if they do more due diligence, they'll see that actually there's a lot of value there, instead of just closing your eyes and doing the FOMO thing and trusting that someone else has done it. So for me, I think, there's a lot of dry powder. People are going to have to start deploying. We'll see interesting ways that they're doing it, but it's about making that pool bigger and bringing more and more of these SMEs and startups into the space to say, this is something that's useful for you.
Thanks, Joel. Someone who has been a beneficiary of some of that deployment has been Sahil, but Sahil want to come from a different point of view right now. Very briefly from you, successfully raised probably has been a journey for you as well. But what are you taking from this news, and what do you think it means for the rest of the year in terms of funding?
It's a very difficult question because the answer is also very difficult. The most amount. So I think what is very important. So I think macro is already covered by Saeed, and Saeed pointed out really good points, and also Jill. But I will go more in micro. How does it feel as an entrepreneur to raise money in Africa, right? Like literally as a pure entrepreneur. I think if I would not have luck, I believe I have a lot of luck and God's hand. If I would not have luck and the network, I would not be able to raise money. But I also believe one more thing: if I would not have luck and network and a mindset of I do not want to raise money from VCs, then also I would not raise money. Like it's also a very mindset. This is both sides, of course. So overall, I see whatever money is there, even the dry powder is not enough for Africa. Africa is huge, and the innovation required in Africa is huge. It's literally like a desert. Even if you put some water, it will just dry away immediately. Is that amount of money we have in Africa from the VC perspective? And I also don't think really large businesses or startups can be built on African VC money. You will have to raise outside Africa. I don't think how do I see Africa VC money realistically is just a buying in for the US VCs that okay, local VCs have invested. It means if local believes in your business, I can also believe in you. It's like a storyline. Otherwise, I don't really think Africa VCs have enough dry powder to be able to fund to lift up the ecosystem to a good level. That's why relationship, network, and luck plays a big role, because it's not widely available, right? That's why it's very niche and specific. So those are the things which are, I think, very important. And I think the businesses, especially in Africa, the businesses which needs to grow should be the need-based business rather than the want-based business. And the need-based business will have in itself the mechanism to be able to not rely on the VC money. If you build with this mindset, and it is very difficult to do it, it's extremely difficult. I didn't know when I switched from VC to entrepreneurship again in the continent it would be that difficult, because I'm also a solo founder. So now it becomes really difficult that if even if you want to raise money, then you have to provide in the name of, like, let's say DD as an example. Good DD is good, but giving all the work for DD to the founder and just asking for a bunch of things is also not good. The founder is already in a shitty space while solving problem on the ground, doing a lot of work, hustling, making sure lights are on, and you and few fancy people will come in and then ask us 5 things. I was that one of those fancy people before, right? Either you handhold, also help them. Okay, you are solving a problem, you are at a very early stage of solving a problem. We are pre-seed fund, we are seed fund. We know you don't have so many skills. We will help you. I think we believe what you're doing as a business. We like the idea. There's a solution, the solution you're working on is interesting. Now let us help you to build that DD with you. That mindset is definitely not there, and it will take a lot of hard work from the VC side to be able to do that kind of work. So from the micro perspective, and this is not a issue with SA Africa. This was an issue everywhere in the world. Wherever ecosystem builds, you will have the novices, then you will have you evolve towards the maturity. And Africa will also reach, I also have a firm belief that Africa will also reach to a point where there will be a pre-seed investment with less DD, because maturity is there. Again, it will happen. But people did it hit them back. Market is tight, no enough money coming in the Africa. Hence, I have less money, more time. What do? Extra DD, of course.
Yeah, of course.
So
I like that. Yeah, I think you raised some important points, which is this notion around, as the ecosystem matures, you'll probably see a lot more of that support at, pre-seed, series A, well, definitely pre-seed, early stages, which is definitely a gap. Very conscious of time. Want to move on to you, Sahid. You've actually closed your pre-seed funding round earlier this year. I want to ask you about your experience. So keen for you to give us kind of the hard-hitting facts around what was hard about this. But then also tell us a little bit about how, luck and network and mindset contributed to your success.
Okay. Thank you. So I'm going to take you guys down, a little story time. So I think we started the business we registered in May 2022. We launched in July. So we actually got lucky because I came from VC, so I had a good network already, speaking to what you just asked. So we're able to get our first check in, I would say, in a few weeks after, and I think it wasn't even fundraising. I think I put it on my WhatsApp status saying, "Hey, start a new business." Had an angel reach out to me, and within a few weeks, got my first 50K check. But I think my mistake at the time, and I'll put this on me versus my entire team, is underestimating the market turn. At the time, just 6 months prior to that, I had worked on deals on the continent where people were raising, millions in weeks. So I didn't realize how quickly the market turned. So it used to be, the year before, your pre-seed check allowed you to experiment. So let's say the first 150K, that changed in 2022. These days you experiment, and today in 2024, you experiment with your own money, no one else's. So we originally wanted to own the entire value chain. So that's distribution of FMCG and pharmaceutical products. Then use this historical transaction data, as well as the usual credit bureau checks, banking data to lay on the services that we provide today. But what we failed to appreciate, and it's actually really the hubris of investors, because I had managed several, B2B retail businesses as an investor, as my portfolio company. And you think you're stuck in, you're not. So what I did at the time was I really underestimated what it takes to run a distribution business, dealing with manufacturers, warehousing, dealing with traders, managing logistics, keeping tabs on the market prices of goods, and dealing with margins, which are razor thin in this part of the world. So that was tough. But I think where we got lucky again is, we kept an eye on our unit economics, on our burn. So after a year, and frankly speaking, 12 months too long. We realized we'd burned through 90% of our capital that we'd raised. At this time, we'd raised only $150,000. And, and then we decided, let the folks who know how to distribute. We'll just lay our financing products on top of that, which is what we did today. And part of that is the downside of being a first-time CEO, not necessarily knowing when to cut your losses. And, I take full responsibility for that. So in essence, we took the long way around. We spent months building the products that we have today, and then we started letting off our own balance sheet, which was the remainder of the capital that we had left. We had to take 100% discount on salaries across the team for 5 months, and that was just to get some level of traction. Turnarounds in capital to show, and it speaks to. It used to be, you had a product, and we have amazing engineers on the team. You have a product, you can raise on that and a story. No one was trying to hear that anymore. I must have spoken to about 80 plus investors, and I think what really burnt me out personally was because of the network. A lot of people would want to speak, and we would also, and I think a lot of people found what we were building exciting, and they liked the fact that we're solving a real problem. And so we would we'd essentially go to IC every single time. So, and like Sahil said, I'm doing the DD. Most VCs don't do that. They don't, get stuck in. So I'm doing the DD myself. So I'm going far into the process with 80 plus investors, yet no one was willing to write the first check. So the margin for error had gone down to 0. And we're just on the wrong side of it. But luckily we got into Baobab, which personally for me is probably one of the few institutional VCs still actually writing pre-seed, first capital in. And, their demo day really helps us just close our round. So that was our story. It was, and again, it took us 2 years to close our pre-seed round. That was almost unheard of, particularly for someone coming from VC as well. That was almost unheard of in 2020, 2021. And it wasn't a particularly large one as well. So in terms of what I wish someone had told me whilst I was there, before I started Hadi, the game is tough. Just don't underestimate. You may think you know everyone. Please, when it's time to write a check, realize you know no one. And you also need to be miserly as a founder, because these days for me, before I spend $1, I need to understand how that's going to translate into money coming back to the company. And I think also just a change in mindset. It seems so simple. And someone told me this like a year ago. So this is actually something someone actually told me. Once you start thinking about your business as a business rather than a tech startup or a tech product, a lot of things fall into place. And I realized to a certain degree, I had abandoned a lot of the, the solid principles of running a business, focusing on your gross margins, customer acquisition costs. A lot of people are like, oh, we'll keep using fundraising as jet fuel. Let's just keep acquiring, we'll figure it out later. You can't do that anymore. That doesn't work. So, we had 5 months without paying anyone. Literally, me begging the staff not to leave was rough. But we come out through it, and I think we're a lot tougher. We're a lot closer for it. And whilst I don't necessarily recommend it, I recommend it in terms of cohesion amongst the team. I actually feel like we're almost in the army now. People at Hadi today, and we're, no matter what happens, we're all in the trenches together. So that's our story.
That is intense. The two things that I really want to take away from there, which you said towards the end, was this first thing around how your mindset and perspective has changed since this experience. The thinking around, like, if I'm spending $1, I need to tie this to how is this bringing in revenue for my business. And then something that we hear consistently when we have these conversations, which is this mindset around you are building a business, right? The fundamentals matter. And if you are just going to try and ride on the wave to keep you, the funding wave to keep you sustainable in the long run, when macro things shift in this sense, when funding starts becoming more difficult, you are putting your startup in a really difficult position. I do want to contrast that, or maybe not at all. It might be similar. But Sahil, before I go to Joel to talk about alternative funding vehicles, What has been your experience having, just recently raised for ShipRaiser from Launch Africa? Obviously, great news for you. But in what ways was your experience different or similar to Sahid's at Hadi Finance?
Thanks for this question. First of all, thanks. You chose a really good panel because I've never met anyone who also was in the VC space and then came to entrepreneurship and then raised money. I think Saeed is the only one another person I know on the continent except me. Uh, I when I launched my MVP. So one thing is that I was kept on building MVP when I was in the job. So I didn't resign before I had a product. So when I launched when I resigned, and the product was shit in the beginning. It needed to be improved a lot. So what I did, I had a very different experience before of my work in Indian startup ecosystem where I spent many years. Then even as a VC, I was in Africa, but I was an entrepreneur previously. I was in India, right? And I learned something in Africa as well. So here, Africa, the focus is a lot on traction. Even though your product is not at all here and there. Uh, in India, it was opposite. The way I have seen it, you focus on product led sales. So you focus on product, and you start, nurturing it. You feedback it. You improve the product, then you scale it, and that's exactly what I did here. But the issue in that is money for building the product and managing the team, and that's where you need a little bit fundraising here and there. And I think luck did play a good role on my side. I raised my first check on a phone call uh, through a contact, and I got my first $25,000, and I raised another $80,000 through my MBA friends. They invested, they combined, they joined a VC fund, like they created an angel syndicate first time just so that see their classmate was doing this thing, and they spent 1 year with me, so they wanted to support. They invested another 85. Another, then we got another 50. Another, again, I'm doing this, there is a relationship. I show high level what product is doing. I had no data room and I raised more than 200,000. And again, so here the luck and all of that plays a role, and I had my own money as well, so I was investing that. So even though the money would not come, I had something, I could fund it. Because I've run previous businesses, and in those previous businesses I had some money. So thankfully there was the dynamics, that's why I'm saying God's support. So dynamics were in such that I was never at the mercy of someone else's money, but I would always wanted to grow this with the joint. So the mindset and the outlook was never in a desperation, right? It was always in, okay, I'm building this, I can build it. If I build it through my own, I have this access and this resource I have. It will take this much time. But if you would invest 50,000, I can hire 3 more engineers and speed up my whole process. And if you believe in me, then what is the issue? So if you have those kind of people, it does help. And then eventually reach to a stage, and literally our real revenue. So last year, of course, I did a soft launch, then stopped the sales for 3 months. So and October relaunched again in Kenya. Within then 3 months, we launched in South Africa. I think no one has probably at this stage have launched 2 countries. It is a different conversation, but then we launched in South Africa in January, and then our revenue just shooting up like this. So because it's shooting like this, because our focus was purely on 2 things in the beginning: getting product right and getting the right partnership right, and hiring very slowly. The first person I hired in South Africa was in June this year. I've been doing everything, I don't know how, but just by myself. All sales, everything, product, just by myself with my tech team behind it to build it. But the product thinking and the business analysis was again because of my tech background. It also helped me a lot. So I hired very slowly. I have hired a few people in the beginning in Kenya. I fired them within 2 months because I couldn't see the return and the zeal, and that is to build a startup. You need different level of energy and different level of shrewdness. It's it can't be a charity. And if there is no VC to do the charity, we can't do the charity. We are also investing in the people so that we can build the business. So there is a So so my focus is a lot been on how do I not rely, how I cannot ask money, like how do I make it myself in a way that I don't have to raise money and don't have to ask for the money. And that's where, this is what I've learned, you can raise the VC money when you don't need the VC money. so 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 literally that, but it is very, overall it is very tough, extremely tough. If I and Saeed face this challenge of raising money, imagine someone really doing some innovative thing in a garage. That person have no chance.
Yeah, 100%. I was literally going to say that because I think you guys had access to the network, you had probably the exposure to, interesting founders building really interesting things. And even that didn't translate into an easy road in terms of funding. But you do touch on something that we know, right? Like I can remember when I was at school learning about entrepreneurship, the advice was around, can you bootstrap? Can you self-fund? Next layer is, can you go to friends and family who can support your endeavor before you even try and secure other types of funding. But I think that's a great segue, though. I want to bring Jill in here. When we talk about funding for entrepreneurs, we usually talk about funding for tech startups, funding for startups and founders in the more traditional VC model. But there's an underemphasis being placed on alternative forms of funding. And why this is even more important, because people operating within the SME space usually are not the people with the biggest networks to tap into. They're not well positioned for being lucky to get those sorts of funding available for their business. So I want to start with you, Jill, and just try and understand for Misfit in particular, the company that you've started with Egla, you focus on flexible working capital for SMEs, primarily female-led businesses. Tell us about the funding gap that exists in this space and what needs to be done to create more access to funding for these types of entrepreneurs that won't necessarily fit into the VC model.
Sure. Thanks so much. So what's interesting is that the VC model only funds less than 0.01% of the SMEs that are started every day in the African continent. To be honest, Africa has one of the fastest growths in entrepreneurship, and specifically women entrepreneurship as well. But VC doesn't fund these types of businesses. And what's interesting is that you have, if you think about it, you've got a $100 billion infrastructure gap annually on the continent. You've got a $120 billion trade financing gap annually on the continent. And you've got VC that keeps trying to give money to tech-only startups. And that's that pattern recognition that I was talking about that doesn't actually enhance and grow the ecosystem, and it's solving a problem which is, the Western world situations where they have the infrastructure there. So yes, a tech only layer works really well, but when you have tech where there's no infrastructure, it doesn't work. We've seen that in health tech in particular. Any electronic medical record, tech-only startups have failed and have not been able to scale. Whereas the startups that have been able to leverage infrastructure, use basic technology to expand that infrastructure's reach, have been able to grow their revenue exponentially and seeing that hockey stick growth. But it's not your typical Western VC tech only, went to Harvard, did those things. Usually the entrepreneurs and the SMEs that are actually solving the issues, maybe they don't have the Harvard education, and maybe they're just a trader that actually understands the market and sees where the issues are. So, what's interesting that we saw is that you've got a huge amount of equity going in. You're seeing that dry up, but you're seeing venture debt starting to take that place. There's two reasons that debt is starting to have a reawakening. One is because all of your LPs have been burnt so hard on SME financing before. Even on venture capital and private equity, you'd be lucky if you got a one-time MOIC on most of these ones. So you've got a whole LP base that's saying we need to get money out, we need to get capital back. And that's why debt is becoming this interesting thing that we're starting to look at. On the other side of it, and this actually speaks to Saeed's comment as well, where yes, you get the equity, but what what do you spend it on? Do you spend it on iterating, or do you start saying, okay, how can I spend this to get the money back? I think that debt is actually a better tool to get your entrepreneur and your SME operator thinking about the strategic alignment of the business. You don't have endless money to kind of fall back on. But I think that breeds innovation. And you've seen that in the fact that the African continent is already leapfrogging using interesting tech. And it's because we haven't had as much access to, a ridiculous amount of capital and so forth. So yeah, from my side, we're seeing a lot more coming out of the SME space, and we're hoping to fund that. We don't want businesses to spend 2 years trying to raise equity. We want businesses to be able to actually get access to the capital they deserve. Bank loans are only funding 7 to 8% of SME loans. So these SMEs aren't getting any of the capital, but they're the ones moving our economies forward. So yeah, it's a $30 billion financing gap in South Africa alone, a $330 billion financing gap on the continent when we're talking about SME financing.
I want to follow that up with a question, which is, when you see that split, even now in the first quarter of this year, but also historically, yes, you can see the debt to equity ratio, starting to shift a little bit, but not enough, right? So that's the first thing. And then the second thing is, when you are looking at the VC funding model is absolutely focused on, we want our return at some point, right? That matters to us. And that's the model that they work with. When you take that to an infrastructural level, however, there's the question then around who should care about funding entrepreneurs that's really trying to expand the ecosystem or the infrastructure within a country beyond, government, for example. So it's that question of who should care about this? Who should care about the entrepreneurs working in this space, when a traditional VC model setup is, I'm investing so that I can get a return, not investing for the prosperity of the ecosystem. What would you say to that?
You'll get a better return and better liquidity by investing in an SME versus a startup. So I'll just give a bit of kind of context and background. We're talking about risk-adjusted returns here. So an SME, the failure rate is incredibly high. You are charging a higher rate because you've got, you're managing that risk there. That SME, most of the time, these SMEs are actually funding, entire families and entire communities, but they don't have access to that next step of capital to take it from a survivor-based SME to something that can actually end up becoming a startup in the future. So, for us, it's about saying, okay, there's this massive gap where, VC is not solving for, the typical kind of SMEs that are moving the needle. But these SMEs are the ones that are generating $3.1 trillion in GDP each year. So there is cash there, and it's actually more profitable, reliable cash flow because it comes from a survivalist basis. And now, actually, for me, it's like there's always been this idea that if you give SMEs, you don't expect a return, and it's too risky, and you do it out of the kindness of your heart. It's the charity to help make your economy grow. I mean, excuse my French, but that's bullshit. These are actually where you can make huge amounts of returns. If they're generating that much in GDP, they're the ones that are actually creating value. So for me, investing in them, you're not going to lose. And we actually saw that. The IFC came out with their 15-year, return analysis on all of the investments that they did, and they invested in the riskiest areas, in countries, industries where everyone said this is just for charity. This is just because you want to help those poor guys back there do better. They beat the S&P 500 by 15%. Wow. And that is what we're talking about, risk-adjusted returns. So what I really want to show with Misfit Ventures is I'm not asking for anyone's charity. I want to be providing you decent, stable returns within 2 years. And I think we can do that by providing local currency debt and still making US dollar returns, because it's risk-adjusted returns.
I think the interesting thing there as well. So I worked for a while for the official opposition here in South Africa, and they had a massive strategy around engaging MSMEs, specifically because there's so many of the people in that space working running businesses in that space. We know this is true for the rest of the continent as well. They are the most resilient, they are creative, they are resourceful. So completely agree with the opportunity there. We have 3 minutes. I warned everyone at the start, we're probably going to run out of time. So I'm going to ask all of the speakers for the next round of questions to keep it as brief as possible. I want to flip the script and then look at it from the actual entrepreneur perspective. Saeed, when I come back to you, we'll do it in reverse order. Can you briefly tell us about the impact? So you at Hadi Finance, you essentially your funding model is not cash, but you help retailers restock and then help entrepreneurs access credit. What's interesting about the segment is that one, it solves for a real need for everyday consumers, and two, to what Jill has said, this is a massive segment of entrepreneurs. So can you just tell us, based on what you've seen from the entrepreneurs that you are working with, what is the impact for them from having access to this type of credit, and what does it enable them to do in terms of growth?
Okay, thank you. What is the impact? So, I mean, I'll take it back to yesterday. So we recently just hired our first marketing person. And I was literally trying to explain to her how I want us to position the company, because a lot of the time I spend a lot of time myself in the markets, like meeting these traders, doing the field work myself along the account officers. And interestingly, I get a lot of feedback. No, credit is, I had a bad experience with Sterling Bank. They kept, it was predatory. I even spent some time on some Facebook pages where a lot of Nigerians have come together to say no to some of these loan shark type, lending products. So what I was trying to position in marketing is credit is neither good nor bad. It just depends on how you use it. So when I think of, and I'll give a few examples of real customers. So last week I was in Lagos, and I met with this woman who's been recently launched in Lagos, and she's been a consistent customer. And we only give up to, as of today, up to 250,000 naira, which I think is circa, I want to say just slightly over 100, maybe just slightly under $150. And we give it for a very short term, 2 weeks, 3 weeks, 4 weeks. And what she said to me was like, since she started using the product, she's very intelligent. Like what she's done is we give her 200,000 naira. She goes and buys from one of our partner distributors. She buys eggs, right? It's important to note that the reason why we don't give cash is because a lot of the reason why, one of the biggest drivers for defaults is you give folks cash in a very hard country like Nigeria. You're trying to take the edge off. You're going to the bar immediately, getting a drink. So we take that away, and so she picks up her eggs, and she sells that 200,000. She takes it for 4 weeks. She sells that 200,000 in the span of what she said to me was 4 days, and then she goes back and turns it over. And what we've seen is that we've got some customers who are really good at deciding what products to really use our services for, right? Eggs, pharmaceuticals, super high margins, spices, super high margins. So we speak to them. I've spoken to customers who've literally gone from traders to mini wholesalers, and that's amazing to hear. And then on the flip side, I've actually got customers who, we have to educate them to explain to them how it works. They buy Indomie in Nigeria. Indomie in Nigeria, can sell for, from a distributor, maybe like these days, like 8,000 naira. You're making 50 naira on that. You're not paying back that money with interest. Come on, stop it. So for us, it's really heartwarming to actually see, to see how it's actually changed a number of traders. As of today, I think we've got about 800 traders across 4 states in Nigeria. And part of why we also lend to them versus consumer loans. We've seen times where, and this is actually some of the comfort that I've given to some traders in the market myself. Hey, if you can't sell it, we have agreements with the distributors. We'll just come pick it up, give it back to the distributors. We get our money back. No harm, no foul. Everyone's happy. You don't have to, because I've heard horror stories like people can't sleep at night because they're getting phone calls at 2 a.m. Where's my money? Yeah. So it's really and that's also why we're maintaining default rates that we are maintaining. Obviously, you have some people who are still bad eggs, so to speak, but generally there's a misconception that Nigerians don't like to pay back their loans. We do. It's just sometimes you have a kid that needs to go to the hospital, and I won't lie, your capital is the first to go. But that being said, where to find. We know where your shops are. We know where your houses are. We do proper KYC. We also assist, and even what we do for a lot of our customers is that we negotiate discounts with distributors. Hey, we're bringing you X amount, drop those prices, let them make a little bit more, and that really, we've seen great benefits to that. So it's just consistent market education. And something to say, this is not linked to the question you asked me, and I think that's what a lot of VCs need to realize. And myself, I didn't realize this 2 years ago, right? If you're trying to build real African products, you need to accept that it takes time. Yeah. You're changing not just biases, but you're changing you're literally educating people from start. People have been burnt. A lot of my customers don't even necessarily know how to. They've got phones. I literally tried to help. There's a woman, she was like 2 years older than me, because obviously we have all the KYC, so I can see date of birth and everything. And she's 2 years older than me, and she doesn't know how to use a phone. No clue. I literally had to help, and then we had to adjust for that, but build out a module to allow our account officers apply for these people under them. You understand? So it takes time to figure these things out. And when you're as a founder, the same way traders don't want the credit pressure. As a founder, like, I'll tell you what keeps me up at night. Where is I think in a month when I do 80% growth, right, month on month, I almost consider that a failure. Like, I talk to my friends and they're like, no, Said, but it's like, you've got a lot of pressure. You've got a lot of pressure to turn, and this is even just speaking to investors, speaking to some of our angels, like, why aren't you at $1 million yet? Like, there are very few build and they will come products in Africa. You need to educate the market. You need to, there's a lot of hurdles, regulatory, that you need to scale over. And that's just the reality of it.
Yeah. Look, thank you for keeping it brief, firstly. I think what I really like about what you said there is that education element, if you're not making that part of the conversation, not only for SMEs, it's also for tech founders, that there's a huge gap there, and we need to acknowledge that. The other point around patient capital, being in it for the long run, you are also trying to build out an ecosystem. You're trying to build out a network. That's also important. And oftentimes things that we don't talk about enough. We are over time. I'm going to end with one last question, and I'm going to go start with Sahil, and we'll work our way around. I'm going to ask you to keep it incredibly brief. And it's the question that was posted by Carl in the chat. I'll keep it, I'll focus for you, Sahil, specifically on the VC side, but then Joel and Sahid, if you could speak from alternative, SME finance perspective. Carl says, you say that the majority of African VCs won't open subsequent funds. What happens to VC in Africa over the next decade then? Love for you, Joel and Said, to answer that from your alternative funding perspective. And then Sahil, your take from just a traditional VC lens would be great. 1 minute.
Should I start? That's what you're saying?
Go for it.
Okay. First of all, I want to say when Said speaks, I really enjoy listening. But when I come to Nigeria, we need to have beer. The pain of entrepreneur and love and hate relationship with the VCs is really amazing. Sorry. So now come to your answer. I think what is going to happen with the VCs in the next 10-year decade? What is that story in English, which rise from the ashes. What is
Phoenix
called?
rises from the ashes.
Phoenix. So it's going to be Phoenix. So right now it's going to ashes. So a Phoenix will come. So what this means is that the industry will get matured. More money will come. I don't disbelieve. I believed really in potential of Africa, and this is why I left my home country and moved here. I really believe this is going nowhere, and I'm not going anywhere. I'm not going back even to India for a couple of decades. It's it is going to happen. Africa is become the center point of the world. It is become so people. We all are pioneers. So what we see is just a tiny bit momentum. I think we will be 90 years old. Our grandkids would be enjoying the rise of the proper upside of Africa. But we need to do that the grinding that work which is required. So that hard work which requires to uplift Africa needs to come out from Africa, and then capital will facilitate it. Capital always follows when they can see the return back.
Yeah.
It's never the capital which allows you to grow. It's always the people, the ground, that hard work. And then capital is like a shark eyes. They will look globally and they see where the most return is coming, and then they will eventually automatically flow in that direction. So that's why I don't I don't believe that capital will not come. It will come. It's just that work requires right now from the Africa continent level at the entrepreneur level right now on the ground is needs to be rock solid, and everything will fall in place. So I'm very optimistic person in generally. So
I
it will.
am drawing on that optimism. Thanks so much, Sahil. Joel, let's start with you. What do you foresee for the next 10 years? And also want to challenge Sahil's point there. I think there's already capital. There is money there. We're just not necessarily getting it to the right kinds of people. So how do you foresee this changing over the next decade?
I think we've already seen that it's not going back to that same pattern recognition. I really don't think that's happening anytime soon. And I think that that pattern recognition is getting battered and bruised in Africa in the best way possible, to be honest. You know, your founders that came from Harvard that were like, yeah, we're going to set up and be fine. It has not been fine. They have not survived Nigeria, and it's been tough. So for me, I think, and we've seen that, you know, the exits we've had have been, you know, diverse teams. They've been local. They've been very much founded in the communities that they've solved the problems for. So I think in the next 10 years, you're going to start seeing a lot of VC funds get surprised that that they were able to get carry and stuff out of some of the startups that they didn't think were doing too well. I even think, you know, some, what do you call it, funder funds will also be surprised. 10 years is a very long time. And I think, you know, when you have that long-term view, for me, it's hard not to be optimistic, to be perfectly honest. You can't say things are going very badly after 2-3 years. That's not a cycle. So yeah, I think we'll see some really interesting lessons come out of it, and I'm hoping that it will continue to go the way where diversity and inclusion is the only way to make money.
Love that. Thanks, Joel. Saeed, take us home.
Yeah, so interestingly, I echo a lot of what Jill has said. Plug and play in Africa does not work, you know. So for me, the way I see the model, two ways or three ways I see the model things playing out. One, I think the barrier to becoming a VC kind of dropped at one point a little bit in terms of what it actually, there was so much capital around. People talk about the founder side, but a lot of, and please, I'm so sorry for the shade, the VCs on this, you know, but a lot of folks, you know, raise funds, you know, but didn't actually know how to do due diligence, you know, and my view is that a lot of these guys are going to die out. And I think I have a very good, I have an opinion about who the real, you know, high quality investors are on the continent, just my personal opinion. And I think those guys will stay. But I think there's a disconnect between, I know we've talked about loads of capital. One of the things I saw in private equity was folks started raising, I think Helios raised $1 billion or dollar fund, African Capital Alliance, and then they realized there weren't that many companies on the continent that could take, I think we're trying to do like maybe like 10, 15 deals. And there weren't that many people on the continent that could take, even $50 million. Right. And that's when you're operating under traditional business principles, not just applying some 100x multiple to revenue in 5 years. So for me, I personally think, this is my opinion. Yeah, I think the funds should be smaller to actually serve the market. The market is still very nascent, so to speak. And I think the final thing, not just the funds, sorry, the funds can stay the same size, but I think the checks maybe should be smaller. And then the third is there has to be some way to meet in the middle for VC and PE, in my opinion, and that's what really works. Like I've had investors, no, that's a lie. I've had one investor, he's a good friend of mine, invest in my business. I have not heard from him since. I call him and hey, what's up? I'm trying to catch up. You want to know how we did this quarter? What's, just Merry Christmas, Happy New Year, get left on red on double blue ticks. And, and it's like a lot of VCs, drop funds and leave. Right now, the nature of the VC model is you may not necessarily be able to be as heavy on the operational side post investments, but it has to go beyond just asking for quarterly reports. Do you have any challenges? No. When I was in PE, I used to go spend time with the CEOs embedded in their factories, trying to understand what is going on. I'm not saying that VC necessarily needs to do that, but maybe the model that may work in Africa is a smaller amount of deals, but not necessarily 10, but maybe not trying to write a check every week. And then actually spending time because as a first-time founder myself, there's a lot that I didn't know, and I would have appreciated the wealth of knowledge that taking it back to the VCs that the VCs have. So particularly we may know things on the market side, but things like learning to manage a team, right? I was an associate at my previous job, so as such. I'm managing a new team. What's going on? How do I get the best out of this person? How do I even just the little things? So like part of what we initially struggled with was, sales. Like what sort of how do we reach this cadre of customers? And these are things that I would have loved more of our investors to be more but obviously they can't be because there's a million Saids, a million CEOs, a million businesses. So I think to answer Carl's question, I think a lot of VCs should die, my personal opinion. Two, I think the better guys, like local content matters a lot. A lot of people come in from America and try to invest in Africa. You don't know what's going on ground. You just have high. You see a nice pitch deck, you see it and like, oh, this is gonna be amazing. No, like actually speak to if I think the local guys, the good guys, the guys who are doing deep due diligence, understand the markets, will start to become a lot more prominent, and they should also invest a lot more on the operational side. That's just my view of how I see VC in Africa.
The other thing that you also mentioned was around that kind of support, founder support, helping them navigate the actual challenges of building a business, managing a team, doing a product, all of those things. Thank you so much. Thank you to all of you. We've gone over time by 15 minutes. My apologies to everyone who stayed on for the last 15 minutes. It was a fascinating conversation. I really enjoyed it. I think that there's probably a couple of topics from this that we should have as a separate conversation. But from my side, I want to thank all of our speakers, Sahil, Sahid, Joel, stepping in at the last minute. Thank you so much for your contribution. Really enjoyed the conversation. A recording will be made available to everyone after this. But from my side, thanks for being gracious with us going over time. And then, yeah, have a lovely evening wherever you find yourself. Thanks, humans. See you at the next one.
Thank you very much.
Yes,
Bye.
Bye.
bye-bye.